You're watching Masters in Trading Live with Jonathan Rose.
Hey traders, it's Jonathan Rose. Welcome to another edition, I guess, of Masters in Trading Live. We get on here live every single day, 11 o'clock Eastern, to go over the market and share our very best ideas. I was thinking, every morning I get in our Discord room, everyone says good morning. There's great vibes, very, very exciting. It's my favorite thing to do in the morning. But, been teaching trading for a little bit now. I've been teaching trading for over 20 years, I'd say. What do you think? The number one mistake that I see in most every trader. Think about it. What do you think it is? What's the one thing? You'll never get it. The number one thing, I feel like let me fix my camera a little bit. The number one thing that I see from over 90% of traders, everyone trades too much. Slow down. Manage your inventory. People put positions on and then go right to the market. What do I do next? What do I do next? What's going on? Slow down. Manage your inventory. When we have trades, if they're going to expire in 90 days and 60 days when you get in, if the market's busy, look at your positions. Do you like your positions? How can you protect your positions? Are you okay if the market falls 10%? Are you okay if the market rallies 10%? As opposed to every single day rolling up your sleeves like, what's next? Where am I going to make money today? Slow down. You have inventory. The market's not going anywhere. That FOMO, fear of missing out, it's not real. A great way to manage positions is using something called divergence. It's relative value trading. That's what we're going to talk about today. Today's going to be all about divergences. We're going to talk about divergences in the metals complex, divergences in bonds, divergences in the energy complex, and even divergences in volatility, in risk. Let's go to the slides. Very important topic. I'll see you over there. Hey guys, what's up? Here we are. Divergence. Let's talk metals first. Metals divergence. When we talk divergence, we are talking multiple products, okay? When you want to buy a phone, okay? If you want to buy an iPhone, you're most likely gonna look at the prices relative to another iPhone. You're gonna look at the bells and whistles. How's the value, right? Well, in trading, people look at things in isolation, but instead of that, every single trade that you make needs to be thought of as relative value. So gold, silver, this line is two products. And all it is literally gold minus silver equals this green line. So if I go back to 1975, now you guys all know how old JR is because that was the year of JR's birthday. 1975, we start looking at gold versus silver, okay? Silver gets very inexpensive. In the 80s, it pops right back up. Now, overall, this is a very, very tight correlation. Gold and silver have been trading in and out of one another since the 1800s. We have 2008 financial crisis right here. Selling gold and buying silver is what this move is. Down here, you would need to buy gold and sell. Excuse me. So down here, this is gold versus silver. So selling gold, buying silver. Just how to take advantage of that. And then when they get out of line, they'll come right back in line. Now, when gold and silver get expensive, like it did right after COVID. That's the highest it's ever hit. It hit 105. That was just a screaming, screaming sale. Gold was very expensive relative to silver. Right after COVID, we didn't sell gold, but we definitely bought silver, and this was just a gargantuan trade for MIT. Gold versus silver, if we look on a shorter term time frame, this just takes us back to COVID right here. Gold-silver ratio spiked right when the world found out about COVID because silver was really, 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 really inexpensive. Well, right here, guys, we just saw the same thing. Gold got very expensive relative to silver. That's why the gold-silver ratio came off. Whenever you're trading these, you have to look at this ratio. How do you know if you want to buy gold or if you want to buy silver? I promise you, here and here, if you want to get long precious metals, you do not buy gold. That's cray-cray. You buy silver because it's stupidly inexpensive relative to gold. That's a divergence trade. We can look at more. This is gold, silver, copper, platinum. Gold, silver, copper, platinum. The trade that we have is we're long platinum, right? We're long platinum. We're long copper. Why? Because they're stupidly inexpensive historically to gold and silver. That's why we're sharing these positions. We're long PLTM from under 9, and then HG. If you've been watching, we love BHP long from 55. Really cool trade. When gold and silver are expensive to platinum and copper, how do you express your opinion? Getting long platinum, you can look at an ETF, you can look at the future, you can look at companies that are influenced by the price of platinum. What do we say all the time? The creative trader wins. This is being that creative trader. When gold's expensive relative to silver, you want to be long silver, not gold. If you can't buy futures, find another way to express that opinion. There are silver miners, there are companies that are correlated to silver, okay? It's a really, really cool way to trade. Let's go back to the charts though. Bonds. Bonds, 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 bonds. The Fed is moving interest rates right now. When we talk about bonds, there's different duration in bonds. So bonds, we can do a 2-year, we can do a 5-year, we can do a 7-year, a 10-year, a 30-year. How long do you want to borrow money from the US government? That's what bonds are, right? Bonds are one of the most liquid market in the world. And this is something that many of you might not know, especially if you've been watching for a little bit. Even my corporate partners, you guys might not know this either. But I've been sharing videos on YouTube going back to 2015. That's how I started my business. I threw a video on YouTube and somebody reached out and said, "Hey, JR, I want to work with you. I like what you're doing." I said, "Great, come on, let's have some fun." So on YouTube, going back 9 years, I post about unusual optioned activity. We also post about our unusual optioned activity scanner. Now YouTube is one of the largest search engines in the world. Unusual optioned activity, you'll see JR's got a video that's 26th in the world. Not bad, whatever, fine. Scanner, we got some at 11, we got some at 14. Very cool. JR knows his unusual options. But what you didn't know is that when it comes to bonds, how to trade interest rate futures and how to trade bond futures, there is nobody more qualified than I am. And I don't say that to be arrogant. I just say that because all of my content is #1 in the world when it comes to learning these incredibly important lessons, especially when the Federal Reserve is moving interest rates. So I just say that. So, hey, if you never heard JR talk about bonds and maybe you went to sleep during that part, I want you to peek back up because as you can see, the world is listening. Maybe you should be listening as well. Here's the bond trade. And this is going to be a little sophisticated. I'm just giving you an overview so you can see just how freaking cool it is. 10-year, 18-year, 30-year. These are all different bonds, okay? High level. There are 3 different bonds, right? 10-year, 18-year, and 30-year. The relationship between the 10-year, here, let's do it this way. 10s to 13s. Let's say that this is 5% and this is 6%. Okay? So 10 to 13 would be valued at 1%, right? It's just the difference. 1 full basis point. Well, let's say this is 5.5%. Now, what do we know? We know that this part is 0.5%, and this part is 0.5%. So this 1, 2, 3, watch this. The white is 1, the blue is 2, and the green is 3. So the bond trade, and again, high level overview, I just want to show you a divergence and just show you that there's really cool trades out there. Look at this. Boom 2, boom 3. That's like this going straight up and this going straight down. That's not sustainable. Of course not. And so it comes right back. There are divergence trades, guys. Every single place that we look, everything we do is a divergence. So every single sector, whether it's equities, bonds, metals, always use a divergence. I got one more thing for you before I jump off to the All Access group. And the final thing is going to be in energy. Energy, closely tied complex, right? Energy. And when we talk about energy, we talk about oil, heating oil, RBOB gasoline. But with oil, you can go to WTI, which is US oil, or you can go to Brent, which is European oil. Which oil do you trade? Which oil is cheaper? Which oil is more expensive? And here you can see, here's we have heating oil, we have oil, and we have RBOB gasoline. All of them trading in and out of one another. The cool thing, you can also replicate this same trade using ETFs. We're talking about this a lot in our Discord. And then finally, same chart, just showing all moving together, all hanging out, brothers and sisters, and then all of a sudden, something changes. When something changes, those are the divergencies, and those are when we look for trading opportunity. Announcement. Lisa, I got you. This Monday is Memorial Day. There's no Masters in Trading Live on Memorial Day because the stock market's closed. Everybody, have a lovely time with your families this weekend. Relax, and we will be back for Masters in Trading Live Tuesday, 11 o'clock Eastern Time. Until then, remember, the creative trader wins. Trade smart. For everybody in our All Access program, we are going to be going over our earnings advantage portfolio. Hang on. I'll see you guys in a bit.